Hello and welcome to Moneycontrol, where the markets pulled off from the all-time high over the last 2-3 weeks because of some disappointments on the earnings front, plus a risk-off trade and negative cues from global markets over the past 2 weeks. How do we go from there? Is there a phase of consolidation that awaits us, or can the market really look past this small, moderation that we have seen and resume its upward journey? To understand the global setup, I have with me a very special guest today, Ed Yardeni from Yardeni Research. Ed, thank you so much for sparing the time to talk to us today.
My pleasure.
Ed, first off, I wanted to talk about the credit downgrade of the US that happened last week from Fitch. How do you see that? Is it all done, dusted, something that we all know, have talked about for a long time, the fiscal indiscipline in the US? Or do you see that as a point that will make some kind of an impact in terms of investor behavior going into the future? Because despite the irony is that despite the fact that dollar is the weaker currency and US economy and US fiscal discipline is under question, investors still seem to take refuge in the dollar and look at it as a safe haven. And that's been the ongoing conversation for past many years. How do you see this time as being different?
Well, I've been doing this for a few years, actually more than 40 years. Over that period of time, as I've been an economist and an investment strategist, I'm very often asked about the federal deficit. And more often than not, people ask me why I don't seem to be as concerned as they are about the deficit. And my response has typically been, I will care about it when the markets care about it. The reality is some of our most significant declines in interest rates occurred when the federal deficit was expanding. And clearly that had a lot to do with the business cycle. During recessions, the federal deficit tends to widen. And during recessions, interest rates tend to go down. What's different this time is that we're not in a recession. And yet we've had a tremendous amount of fiscal stimulus, a tremendous amount of increase in fiscal outlays, and that's really showing up in the federal deficit widening significantly without a recession. And so I am becoming a little bit more concerned to the extent that the financial markets seem to be becoming more concerned. And I think the Fitch rating downgrading of the U.S. debt kind of brought a lot of these things to the fore. In other words, everybody's known that we've got lack of discipline in the United States in Congress in terms of spending. So this is not really news, but then again, it is different this time to the extent that we've had a lot of fiscal spending before a recession ever occurred, and it's one of the reasons a recession's not occurring. And of course, if we do get a recession, the deficit's going to be even larger. So the markets care about it right now, but we're still kind of hanging there around 4%. We managed to finance some of the auctions today relatively well. So I'm concerned, but I don't think it's going to be an immediate problem for the economy or for the financial markets.
Sure. Ed, do you see any permanent changes in the way asset managers allocate assets across, developed markets and emerging markets? Is that like a, permanent trend, irrespective of the trajectory of the dollar or concerns about the dollar? Do you think there is going to be a permanent shift and more in favor of emerging markets continue from here onwards?
Well, it's an interesting question because here in the U.S., even for investors who just stay local, just stay domestic, focusing on the U.S., they've had a big question about what to do in the market when we have 8 stocks, I call them the mega cap 8, that account for something like 27% of the market capitalization of the S&P 500. Most professional investors and individual investors as well do try to have a diversified portfolio. But if at the same time you're benchmarking yourself to the S&P 500, it's pretty hard to beat that portfolio unless you really concentrate your bets on just a handful of stocks. Global investors have the same issue. These mega cap 8 stocks have been one of the reasons that the United States market has outperformed most other markets over the past few years. And so a lot of investors are trying to figure out, well, what do you do here? I mean, obviously, after the kind of rebound that we've seen in the mega cap 8, it's hard to buy them aggressively since they are already back being quite expensive. So I do think that there are quite a few global investors that are looking around for alternative opportunities that present better values. And so clearly, emerging markets are cheaper than the US market, but so are other markets. The Japanese market until recently was cheaper. The European markets was cheaper. But a lot of this cheapness is, again, because of these mega cap 8 stocks. Take out the mega cap 8 stocks. Well, with the mega cap 8 stocks, we have a forward multiple of about 19 and a half on the S&P 500. Without them, we have a multiple of about 16 and a half, which is obviously more reasonable. So I think there's plenty of room for global diversification. I think on a global basis, investors are struggling with China. Do they want to invest in China at all, given that the government has taken a pretty severe stance towards business, obviously regulating and supervising business much more closely in a way that makes it hard to do business in China. So we do know that companies are looking to leave China to find other places to produce, and obviously investors have to decide, well, what does that imply for investing? And I think many of them are concluding that they want to be less exposed to China. As it is, China's economy is in trouble. The data that's been coming out recently suggests they're in a mild recession, maybe even a severe recession. And a lot of that has to do with their property market. But problems in their property markets are depressing their consumers. And so I personally think that China is not a good place to invest in right now, both because of their economy and and the government's attitude towards business and investing. And obviously that benefits other countries like India, like Brazil, some of the bigger emerging markets.
Ed, would you hazard a guess about when the Chinese economy could actually recover? Because we have had a lot of false recoveries in the past. First of all, can you hazard a guess as to when a recovery could actually start,
Right.
and how would that impact the relative valuation or the relative positioning across markets?
Well, China's a tough place to invest these days, as I said, and it works both ways. If you don't invest in China, you run the risk that the Chinese government will provide another round of very stimulative policies that will revive their economy. But I think they've been doing that for a long time, and I think those kind of stimuluses just are losing their effectiveness. And I think that has a lot to do with the rapidly aging demographic profile of China. The one-child policy has come back to haunt them pretty significantly, and as a result, their population is aging very quickly. They have fewer younger workers, low-wage younger workers, and I think that's also depressing their economy. I mean, even the young people, a young couple getting married in China has a responsibility to their older parents, and so they may very well have not only to try to finance their own lives, but also help out their parents. And because of the one-child policy, you have one child for two parents. You don't have two or three children helping out, and so I think that's depressing their consumers. So I'm actually pretty pessimistic on China from a kind of a structural long-term basis. I think in some ways there's some similarities with Japan. Japan hasn't been a bad place to invest, and there have been opportunities. But I think China's in many ways a bigger version of Japan in the sense that they both share a similar aging demography. They both share a government that's spent a lot of money on building all sorts of beautiful state-of-the-art infrastructure. The problem is in a place like China, where you have these magnificent airports and fast trains and great roads, an older population isn't necessarily going to be using those kind of facilities. So they may have built a lot of infrastructure that isn't going to be all that useful to people, and maybe too expensive when it comes to, for example, running a high-speed railroad. So I think on a short-term basis, they could provide some more stimulus. They're talking about providing more stimulus to try to get consumers to spend. But I think there's some real structural problems related to their demography that make it very unlikely that they can substitute their export-led economy with a domestic consumer-led economy. And meanwhile, on the export side, because of the geopolitical tensions, as I said, and we know a lot of companies are looking to leave China. A lot of investors don't want to put more money into China in terms of physical capacity. And so that's also weighing on China.
Sure, Ed. How do you size up the Indian opportunity in this context? You know, some part of it was, of course, very well documented in terms of the advantages, but opportunity
Yes.
versus, what the stock prices seem to be already pricing in. How do you see that equation?
Yeah, well, that's the problem with the markets, right? They discount, they think ahead, and so we clearly have seen the markets anticipating that India will be one of the beneficiaries of the geopolitical tensions between China and the United States, China and Australia, China and the Western world, basically. And India is a democracy. India has a great demographic profile. There's more that can be done on an infrastructure, clearly, but to the extent that India looks like a very good alternative to China, money will go to India, and things will continue to improve there and present opportunities for global investors as well as domestic investors. And the markets have already figured that out. So it's hard to say that this is an opportunity that hasn't been discovered. But that doesn't mean that it won't be a long-term opportunity. Just the same way that I have long-term concerns about China, I have long-term optimism about India.
Sure. Ed, you talked about, a US recession not happening, and now it's amply clear because even the Fed doesn't seem to forecast a recession. It's completely out of the conversation. First of all, in your perception, why has this recession not happened? Because everybody has been anticipating for the past 1 year that there will be no chance of a soft landing. At least a majority of the economists predicted that inevitably we will see a recession. First of all, the fact that it hasn't happened, does it increase the probability of it happening at some point in time? That's question number one. And second, how do you see the rate trajectory itself moving from here on?
Yeah, well, with regards to the discussion, maybe the one of the reasons that hasn't happened is because it has been the most widely anticipated recessions of all times. Usually recessions kind of sneak up on us. We have a boom and then suddenly something breaks in the financial system and we have a recession. This time around, because the Fed has been so aggressive in raising interest rates, it's clearly caused a lot of economists to conclude that this clearly, obviously has to lead to a recession. I have not been in that camp. I've been arguing, actually, let me put it to you this way. I've been arguing that we've been in a recession since the beginning of last year. So while other economists were saying we're going to be in a recession soon, I've been saying we're already in a recession but it's what I call a rolling recession, impacting different industries at different times. So we certainly rolled into a housing recession very quickly last year, early last year, as interest rates went up. Then we saw a very interesting move by consumers. They bought lots of goods following the end of the lockdowns from the pandemic. They couldn't really buy services. They couldn't travel very much. There were still restrictions. And so they went on a buying binge for goods, and that kind of came to an end. They kind of maxed out on buying goods and started moving towards services. So we have had for the past couple of years, maybe year and a half, a recession in the manufacturing sector, in the goods sector, maybe more of a growth recession. There's been no growth. Retail sales have been flat in the United States for the past year and a half. But retail sales is merchandise. The service economy has been doing extremely well. People have been going to restaurants, have been traveling, they've been staying at hotels. So the service economy is doing very well. Now we're rolling into a recession in commercial real estate, particularly office buildings. Um, but the consumer is still spending. And I think the consumer will probably continue to spend, given that the labor market still looks quite strong, and it sort of feeds on itself. People go out to restaurants, they go to hotels, they go to the to travel, and that creates a lot of jobs in the services economy. And then those people who get jobs have money to spend. So I think that the economy now is showing signs of actually moving from a rolling recession to a rolling recovery. Even housing has looked somewhat better, though the recent backup in interest rates doesn't help. Now, what was your second question about interest rates? Did I hear
Yeah,
that?
yeah, yeah.
Yeah. Well, look, the resilience of the economy has been really quite remarkable in the face of a 525, 550 basis point increase in short-term interest rates since the beginning of last year. Mortgage rates have gone up from 3 to 7%, and that's clearly put a damper on the housing market. But the overall economy has proven remarkably resilient. One of the reasons is we never had this kind of fiscal stimulus before a recession. We usually have fiscal stimulus during and after recessions, but because we've had so much spending on infrastructure and on incentives to bring manufacturing back to the US, the overall economy is doing well. So I think the Federal Reserve has been quite clear about what they intend to do, and so far, the playbook has has been going along pretty much exactly as they have been saying. They said that they want to get the short-term rate, the federal funds rate, up to a restrictive level that they think will slow the economy down. More importantly, that will bring inflation down. But they don't. They would prefer to bring inflation down without having a recession. And I think there's evidence that 5.25, 5.5% on the federal funds rate is restrictive enough. It's doing the job. We had a banking crisis in March. We just had Moody's a couple of days ago downgrade the banking sector. We have the Fed survey of bank loan officers saying that they're tightening lending standards. And the weekly data on loans suggests that banks are becoming more cautious about lending. I don't think this all ends in a recession, but it does mean that we're not going to have a boom anytime soon, and that the economy just continues to grow at the slow pace. And as I said, I think there's another part of this rolling recession coming in office buildings. So I think the Fed's done. I think the Fed's going to keep the Fed funds rate at the current levels. They said they want to keep it at a restrictive level until they see more progress on inflation. I think we are going to see more progress on inflation. And then already John Williams, who's one of the key members at the Fed, has recently said that, if we do see inflation coming down next year, the Fed may very well have to lower interest rates. Otherwise, from a perspective of real interest rates, monetary policy would be getting tighter. So I would say that we've seen short-term rates and long-term rates peak out. Ask me again after the CPI comes out tomorrow morning here in the United States. Everybody's nervous about that. It's the July number. And I guess, I could be surprised. It could be higher than expected, but I think it'll In my opinion, it'll continue to show moderation. And then the next day, Friday morning in the United States, we're going to get the producer price index. And I think we're going to see deflation there. We've seen deflation there the past month or so. And that tends to be highly correlated with China's PPI. And we're definitely seeing deflation in China's PPI.
Sure. So, if the numbers come in line with expectations, Ed, when do you see the first cut happening from the Fed?
Well, I have not been in the camp that believed that the Fed was going to be cutting interest rates anytime this year. Again, economists usually don't like to agree with the Fed. They like to say, well, the Fed can't be right. They're never right. You know, they have the attitude that of being critical of the Fed. But I've, in this case, been arguing that, you know, maybe the Fed actually finally is going to get it right. Talk about a contrary opinion. And I think they are getting it right. And if that's the case, then I don't think they're going to be lowering interest rates this year. But John Williams, as I said, already has put on the table the possibility of lowering interest rates next year if inflation comes down. And as a matter of fact, the Federal Reserve every 3 months comes out with what they call a summary of economic projections of the key members of the FOMC, the Federal Open Mouth, I call them the Open Mouth Committee, of the Federal Open Market Committee. I call them Open Mouth because they talk so much. But you know, what I'm hearing them talking now is about inflation, that inflation may very well come down, and that's in their summary of economic projections. They are aiming to get inflation down to 2%, not this year, not next year. They want to get it moving in that direction, which it is. They want to get it to 2% by 2025, and I think they can. I think they're on course to achieve that. And if that's the case, and they feel that they are on the right track, I think that they will be lowering interest rates. I don't think that monetary policy was the only cause of inflation. I don't think it's the only way to bring inflation down. I don't think we need a recession to bring inflation down. Look, if China is going to have a recession, that's going to be deflationary for them, and they do a lot of exporting that creates deflationary pressures in the U.S. and other markets around the world. So I think there's a potential for short-term rates to come down next year, which then would also bring bond yields down.
Sure. Ed, one last question. Earlier this year, when the SVB episode happened, obviously the markets were really worried that, you know, more such accidents will happen along the, down the road. That hasn't happened. Of course, there is some weakening in banks that have been flagged off in US banks. Do you worry about any accidents? Because the question is, how is it that we have seen the steepest climb in history in terms of interest rates and nothing broke? Or well, nothing of really, consequence really broke?
That's a very important point because, you know, a lot of the pessimists have been looking at the inverted yield curve and where they see the 10-year yield is below the 2-year. And so, you know, historically, that's always worked. For the 8 out of the past 8 cycles, it's predicted a recession. And yet this time we haven't had a recession so far. And yet some of the diehards are saying, just wait, it's going to still happen. The yield curve is inverted. I don't think the yield curve predicts recessions. I think it predicts a process that leads to a recession. What the yield curve, I think, historically has done is I mean, why would anybody in their right mind buy a 10-year bond yielding less than a 2-year? Well, that's because they don't think the 2-year rate's going to be staying up over the next 10 years. They think the 2-year is going to fall, and they think the 10-year bond yield is a pretty good rate to lock in for the next 10 years. And so in the current situation and in the past, inverted yield curves, I think, basically signal that if the Fed continues to raise short-term interest rates, something will break in the financial system. That will cause an economy-wide credit crunch, which then causes a recession. So again, something breaks in the financial system, you get a credit crunch, and then you get a recession. This time around, the yield curve has been right on the money. We got a financial crisis, we got the banking crisis, but the Fed came in with liquidity very, very quickly and calmed the situation down significantly. The banking credit is tightening, but we're not seeing an economy-wide credit crunch, and as a result, we're not seeing an economy-wide recession. So I think that's how this time has so far been different from the past. I'm not going to tell you that there's no way we're going to have a recession. It still could happen. It would require the consumer to really significantly retrench. And right now, the labor market is just too strong to really conclude that the consumer is suddenly going to stop spending. And meanwhile, we've got a lot of fiscal stimulus, a lot of onshoring. We've got a lot of capital spending as a result. Put it all together, and I think it's the economy continues to grow with inflation continuing to come down. And I think the Federal Reserve is done.
Sure. Thank you so much, Ed. I guess that's all the time we have today. Thank you so much for joining.
Thank you. Bye-bye.
Bye-bye.